As a journalist, I've been listening to all these people for the past couple months, and you hear a lot of arguments and debate, but kind of as if you turn a radio dial very finely, you start to hear the harmony. What I'd like to say is all these people on this panel have a common interest, and that is to promote home ownership. Every one of them has worked hours and hours and years to promote home ownership. Why is that important? I think in a world of globalization, we're seeing that income growth is somewhat suppressed for certain people. But if you can own assets, you can do pretty well. So it's never been more important to have a stake in something through asset ownership, and that's why home ownership is important. It won't take too much more time, but I want to read something from 10 years ago. A university professor went before the Senate Banking Committee, and he said the following. You don't hear this kind of language too much these days. Sometimes one's advice must be weighted towards economic practicality, sometimes towards humanity. A good economist should know how to balance both objectives, which is what I have tried to do throughout my career. This book by Dr. Gramlich asks the question, is subprime lending the way to promote home ownership? And all these people have an opinion about that. And I think, as he said in his nomination hearing in September 1997, those words I just quoted, it's a balancing act. And I'll let him talk about that right now.
Okay, well, thank you very much, Craig, and also Bob for your generous remarks. I got interested in the issue of housing and subprime mortgages and so forth at the Fed. I joined the Fed in '97, and at the time the subprime market was just taking off. And, initially it seemed very good because it was bringing credit to people, minorities, low-income people who couldn't get credit before, who had been denied and now looked like they would have a chance to own a home and build wealth. What the book does is to first tell a story of how this all happened, why it happened now. The basic facts of the matter are that we had a first housing boom in the 1950s, where the overall U.S. ownership rates went from 45% to 65% in the space of a little more than a decade. And then the ownership rate stood at 65% for almost 40 years. But in the late 90s, it started going up again. And so I call this the second housing boom. And I begin the book by contrasting what happened in the first housing boom and the second housing boom. First housing boom was focused on the prime mortgage market. The 30-year 5% fixed-rate mortgage was the financing instrument of choice. This is the instrument that probably permitted most of your parents to get their house in the suburbs, and it, in effect, built up suburban America. The second housing boom that happened in the mid-'90s and still going on was very different in many ways. The prime mortgages had 20% down, fairly low interest rates, fixed interest rates for 30 years. The subprime market was for people with worse credit histories. Often there was very little down payment. and something that should be scary to all of us. There was a much greater use of adjustable rate mortgages in the subprime market, where you would think, these are exactly the wrong type of people to have adjustable rate mortgages, but adjustable rate mortgages are the mortgage of choice in the subprime market. Another issue is that in the prime market, we always had very tight supervision. Again, I learned about this at the Fed. We have supervisors that go into banks every 3 years and examine the books, the way the banks make loans, whether everybody's in compliance with a whole list of consumer protection statutes and so forth. The subprime market, there is very loose supervision. In 2005, for example, 30% of loans were made by subsidiaries of holding companies and things like that got less supervision than the banks or thrifts. And 50% of loans are made by state-chartered independent mortgage companies that had no federal supervision at all. So that should set up another red flag. Bob addressed the foreclosure issue. It was 7% on subprime markets when I started this. The overall rate now is 15%, but the Center for Responsible Lending issued what to me was an eye-popping report last December. Said in the latest mortgages, we could have foreclosure rates of 20%. So back to the book. The first issue is to tell the story of how all this happened, why it happened now. The second issue is there are a lot of players in this game. They're banks, they're borrowers, they're capital markets, they're community groups, they're who knows what else, regulators. And so I try to put this all together, how it all fit together and how it evolved historically. There's a huge amount of data in the housing area. There are all kinds of housing surveys, and there are income surveys, and the Fed has a survey of consumer finances. And you can learn a lot about what happened, who are the new homeowners, how have they done, and so forth from that. So I have a long chapter on data, basically trying to figure out who's better off, who's worse off, and what the trouble spots are. Another issue is that we often talk about home ownership as if it's the only thing. Well, it's not the only thing. You can own or rent. And what has gone on while we've had the rise and fall of the subprime market is that the rental market has been very, very tight, almost disgracefully tight, for people who want to rent a home. They often have to find their home miles from where they live. I visited Orange County, California for some trips at the Fed, and everybody in Orange County needs a gardener, but there are no places for gardeners to live. They have to live over near Nevada somewhere, and this is really a great paucity of rental housing. And the two tie in, and I want to get to that point at the policy section. And the last thing I try to do, of course, is to we got some problems here. How do we fix them? Now I will. There's going to be a lot of discussion on this part, so let me quickly go through my own fixes. The first, I think, is obvious. There is a supervision anomaly here. The market that needs adult supervision doesn't have it. The market that obviously or that arguably may not need so much adult supervision does have it. I'm not arguing to get rid of bank supervision of the prime market, But I am very definitely arguing to bring more supervision to the subprime market. I have some ideas in the book for doing that, but one thing I would like to do is to complement my alma mater, the Federal Reserve. 2 weeks ago, they came out with a package for solving this issue, which I thought was great. It's a real sea change for the Federal Reserve to be doing this, but it was a marvelous package, and like to compliment Sandy Brauntein and others responsible for doing that. We'll probably talk about that some this morning.